Yeah, good evening.
Good evening, sir.
My voice is clear?
Yes, sir.
Yeah. Yes. So where are others? Only 4, 5 people. Today is very important topic I want to take.
13 people have come, sir.
Huh? 13 people. How many are there in the class?
Total 14. So minus
Total
2, 12 people are there.
Okay, not a problem. So majority is there. Not a problem. So let's start. So last time we were discussing about the uh, performance of the portfolio, and you must have got proper view of that. Only one ratio was left, that was the Sortino ratio. Did you get the notes on that?
Yes, sir. We got it by mail.
Yeah. So there you are just calculating standard deviation when return is less than the risk-free rate. Okay, I'll just explain. Don't worry. Don't worry. So last we did everything in the performance of the portfolio. The last was the which we could not cover on that day, but I put it on the notes. That is the Sartino ratio. So this is the nothing but excess return of the portfolio divided by the sigma of downsize, sigma down. Uh,
Sir, by any chance you are typing in the slide goods?
yeah,
The screen is not
I have,
shared.
I have to share. I have to share. Yes. You're right. It's from my side. Yeah, these are the things I have to share. Yes. Yeah, full screen. Yeah. Are you getting this? Sartino ratio. I asked Dhiren to share with you this Sartino ratio, where this sigma down. So suppose I am having period 1, 2, 3, 4, 5, 6 .10, and my suppose risk-free rate is equal to 6%, and my return of portfolio. So I will be taking expected return for the all, but the sigma will be only for the downsides. So suppose this is equal to 3%, then 9%, then 12%, then 4%, then 5%, then 12%, then 3%, then 2%. Suppose this 1, 2, 3, 4, 5, 6, 7, 8. Okay. And so 10, this is 8, 9, 10. So this is again 5%, and this is equal to 12%. So here I will calculate expected return average. So average will be nothing but, so average return, this is nothing but be 3% plus plus 12% divided by 10. That will be the average, and this will be my expected RP. So return of portfolio like this. But sigma down is equal to SD of returns when less than RL. So my SD of I have to take calculate 3%, then it is 4%, then it is 5%, then this is 3%, then this is 2%, and this is 5%. So SD of this series, SD of this, SD of return of portfolio less than RF is equal to sigma down. So Sartorius ratio talks about the how much excess return over RF we are getting for 1 unit of downside risk. So Sartino explained that okay, the why we are looking at. You see, when we are calculating standard deviation, so this is my distribution, portfolio return. This is my mean. So my return goes this much. Suppose this mean is suppose 12%, and this value we suppose coming out to be 25%. So my return goes from mean to 25%, and then here my return goes to suppose minus 9%. So from 12% to minus 9%. So going this side is not my, this is not risk. This is not risk. So this area is not risk. Risk is where? Tell me. Loss. Risk means what? The area below this, where my portfolio is giving me the negative return, this is my risk. Risk means loss, loss of the portfolio. So if I have a constructed a portfolio of 1 crore and it becomes 10 lakhs,
Suggest any good resorts, something
so
like
my
that.
risk is 90 lakhs. And if my portfolio gives you the higher return goes to the 3 crore, from 1 crore to 3 crore, this is not risk.
So
Risk is
like
the downside.
that all again you
So
will like to
sigma
like reefs
is
you
the
will take for
SD
the
of
investment
return.
and what will not. So that
We measure as a risk. We take as a risk. But SD measures both the sides, positive side and the negative side. So it's not a since it's as a deviation from mean upward and downward, both. So upward is not my risk. So we need some measures to correct my this thing. So sigma is not a correct measure of risk. Sigma doesn't talk about downside. Sigma sigma does not give the downside risk or my expected loss. But how much I am going to my portfolio. I have a constructive portfolio, collected 50 stocks, and I have put my money. What is my expected loss? Any portfolio manager, they just give you the sigma. But the sigma is taking the both the sides of this thing, because the formula of sigma is equal to 1 over n summation of Ri, return of each period, R bar, that is my expected R, uh, this is a square, and then you are taking the under root of that. So you are squaring this return, you are squaring this return, you are squaring this return, and this is nothing but the deviation from both the sides. So Sartino suggested don't take deviation from this side. This is not risk. Risk is when your return of the portfolio is less than RF. Risk is this. Risk is equal to this thing. So find out the values where your return is less than RF and find out the standard deviation of that. So he is talking about, Sartino is talking about SD of returns, SD of returns which are less than RF. That is my, this is RF. Why this is not taking complete picture? This is RF. Risk-free rate. And RF is my risk-free rate. And this is what 10-year bond rate. So what is the yield of 10-year bond rate? That is supposed to be your risk-free rate. And this thing you can easily find out what is the risk-free rate in India. So sites are there, or you can go to the directly to the risk-free rate in India. Just click on this, you will get. So the yield of 10-year government bond GSEC 2024 is 6.79%. So find out the years when the return was less than 6.79%. That will measure the downside risk. And that's why the Sartino criticized the Sharpe ratio, and they also criticized the Tennis ratio. Tennis ratio beta is again talking about the correlation between the risks. Obviously, they are talking about the systematic risk, but still they are talking. So any deviation from mean, and that mean is from right side. Mean is suppose 12%, and my portfolio is giving me 20% return. My portfolio is giving 20% return. So this average return is 6.75. So risk free is 6.75. My portfolio is giving 12%. This is not risk. My portfolio is giving 15%. It is not risk. But if my portfolio gives 3% return, I am losing my money. Or if rather not giving 3%, giving negative return, negative 5%. So my principle of investment violates. Principle of investment is what? We should preserve the capital. We should appreciate the capital. We should beat the inflation, and our return should be incommensurate with the risk. And there should be income during my investment period. These are the simple principle of investment. And obviously there are constraints, and constraints are the liquidity, the tax, the legal compliances, and the horizon, this investment horizon is also a constraint. So under these constraints, if I'm losing my money, that is my risk. I expect it. So whenever you just see the Sartino ratio, when your portfolio return is less than RF, this upper side will be negative. And standard deviation cannot be negative. It will always be positive. Standard deviation cannot be negative. It's because you see, the formula of the standard deviation is that you are taking Ri minus Rs square, you are squaring it, and then you are summing it, and then you are dividing it by n, and then you are taking the under root. So this quantity can never be negative. But my numerator, the moment expected return on portfolio is less than RF is 6.79 and expected return is 3%, 2%, or minus 3%, minus 4%. This whole thing will be minus. So I will get for 1%, 1 unit of my downside risk, how much excess return over RF I am getting. So this is the measure by the Sartino ratio. And now you have, so Sartino criticized this thing. So Sharpe, you are taking note. Standard deviation cannot be a correct measure of risk. Even beta cannot be a correct measure of risk. These two people talked about risk. So now I'm going to talk about risk and what is the correct measure. So what is risk? So risk, so what is the risk of a portfolio? What is the risk of a portfolio? First question is this: if the standard SD of return is not correct measure of risk, which till date everybody in 9 classes you were just saying SD of a return is a risk, is not a correct risk, then what what is a measure of risk? Third question: what is value at risk? We say that VAR. Then fourth question, these are all questions. How we calculate value at risk of an asset and of an of a portfolio. अगर है ये correct, what is the value at risk? How we calculate it? Then why? What is expected shortfall? Why both value at risk and expected shortfall can be taken as risk? 6, 7. Why stock prices respond to interest rate or interest rate increase or decrease? Most of the time, every time, whenever monetary committee meeting is there, you are interested in the market. And the moment they increase the interest rate, immediately stock prices go down. And the moment interest rate goes down, immediately the stock market, all prices, they go up. And that's why you are every time you are interested whenever the meeting of the monetary policy committee is going on, because there are two types of policy: fiscal policy and the monetary policy. Monetary policy of a country is decided by the central bank. In India, it's a Reserve Bank of India. And moreover, you are also interested in to hear about Powell, what Powell is doing in US, because it's the response in the US market, it affects the Indian market also. So if the US market is going up, Indian market will also go up. Gift City, if at 7 a.m. if Gift City is going up, definitely your market will open in a green candle. And if Gift City is going down, so your 9:15 a.m. your market will open so you look for the what has happened Dow Jones, what has happened in US market, how in the morning it is responded in Gift City, what is happening there, because Gift City trade starts early. So how these are really affected. And every time, every monetary policy meeting, you get the opportunity to enter in the market. You sell the stock, by sorting the stock, you are getting the gain. or you are buying the stock. If your market become bullish, so you buy at a lower price and sell at a higher price, or you are sorting at a price and then you are again buying it at the end of the day, near the end of the day at a lower price. So this is simple trading because you knew that the market will go down, market will respond. Now, so first thing, theoretically, you have to. I just want to build up this to make you understand. You see, the risk started in 1960s when all the central banks decided that they are not going to intervene in the exchange rate. Earlier, what were every country, they do not want to let their currency down, so they were maintaining the demand and supply. So if supply is increasing, so they start buying it. If demand is less, so they start selling the foreign currency. So intervention of banks was like that. So exchange rates were stable in 1960s. All after the World War 1945, all countries were intervening, and there was much of interest that my currency should not be devalued. So they were maintaining demand and supply. So there was not much risk. But all of a sudden, in 1960s, all central banks decided that they will not intervene in the exchange rate market. Let market decides the value of the currency. So they will not going to increase supply, or they are not going to decrease supply by buying the exchange by the currency. So this was the major reason, and this because the market is volatile, the people were taking positions, and lot many people speculation is going on. People who do not have interest in currency, they are not imported, they are not exported, but still they have the knowledge that the USD price will go up. So dollar is going to appreciate, so they start selling currency, so USD INR. So like that, this is the or if it is in future, it is going to miss. You see the in derivatives market. So there are two types of market. One is the spot market, and another derivative market. So if they find that in a spot market, USD currency will go up, so they will take the short position in the derivatives market, equal and opposite position. If they find that in the spot market currency is going down, so they are going to take the long. So this is the this just equal and what is the behavior in the spot market. I will just show you that how to hedge and all those things, how to use derivative product here also, because you have a portfolio, and you do not want that your portfolio value should go down. So in derivatives market, you sell the index. You sell the index. You have a portfolio of 5 crores rupees, and your risk is that price of your portfolio or the value of your portfolio will go down. So you are incurring loss in the spot market. So you are taking equal and opposite position in derivatives market. So you are selling Nifty 50 or S, depending upon your the portfolio, where the which is a mirror image of that. So you are selling that for. So despite here you are losing, since you are selling at a higher price, so both the prices meet out. This whole process is known as the hedging. So because your portfolio is not available in derivatives market, so either you are taking in the option market, or you are going to the futures market. So in the futures market, you are taking the short position, and because you are selling your portfolio. So what you're selling? So you are taking the what long position input. You are taking the long position input or short position in call in the option market to sell your portfolio. Well, sell the index. So whatever the loss is there in the spot market is going to hedge in the derivative. We'll be doing this thing. I will be elaborating later. So first understand from where this risk started. Then the era, so people were started hedging the exchange rate risk. And this is the era, that's why the derivatives product, option, futures, they were introduced to instrument to hedge the risk in the spot market. Later on, exchange rate was something obviously creating a problem. Interest rate risk has become a major thing because the interest rate was controlling the liquidity in the market.
Recording in progress.
20,000. So I will hedge this 20,000 in my derivatives market. Okay, so that my value of the portfolio should not go down. And obviously, if you're hedging something, means the Markovich talked about the diversification. Add your assets in your portfolio so that your risk is diversified. But now you see interest rate risk, exchange rate risk, inflation, or any country risk, or the news because of the market is going up and down. It cannot be diversified. It has to be hedged. Hedging means you are transferring the risk to somebody else, and it means you are using derivatives products to hedge your risk. And using the derivatives product to hedge your risk means you are transferring this to somebody else. Since you are taking a short position in a futures contract, the person who is taking the long position in the futures contract is going to take care of your risk. So you get loss in the spot market, but you get gain in the derivatives market. So in this way, you are hedging. Now, I just want to tell you why this interest rate thing is so important, or the monetary policy is so important. You have to understand. I don't know whether while I initial lecture I'm unable to understand, because liquidity is a major problem in the market. Whether the government policy or the monetary policy is sucking the liquidity, or they are infusing the liquidity in the market. In both the situation, market will respond. If interest rate is down, so what will happen? Liquidity in the market will go up. Are you getting my point? If interest rate is down, means there will be demand for capital expenditure by businesses. So liquidity, lot many people will ask for the loan, or people will take loan and do expenditure. So market will expand, and since market is expanding, businesses are doing well, so stock market will go up. So whenever you see, so this is a relationship. So what is the monetary policy? So what monetary policy does? Monetary policy of any country or central bank, it increase the liquidity in the market, or it decrease the liquidity. Decrease the liquidity in the market. So if increase the liquidity in the market, how it will do? It will bring down the interest rate will go down. Interest rate will go down means liquidity will go up. So more demand for credit will increase. So इसका मतलब क्या हुआ? There will be more spending. More spending means business will gain, and this means the stock price will go up. Stock price will go up, and price of all product will go up. क्योंकि सबके पास पैसा है खर्च करने के लिए. So इसका मतलब क्या हुआ? Stock price will go up. तो ये एक और बात क्या बता रहा है? Inflation will go up. Inflation will go up. Decrease in liquidity means market में बहुत सारा money supply है. Everybody is buying. Price has gone up so high. Everybody has money in their pocket. They're buying everything. Price has gone up. Now government wants that no, inflation has gone up. So when it is this, so inflation is very high. Inflation is very high. Prices are very high. Prices are very high. Now this is the symptom. Why to decrease liquidity? Because inflation is very high. Prices are very high. So now what it does, it decreases the liquidity in the market. Why? How? Interest rate will go up. Interest will go up, so there will be less demand for credit. Price will go down. Businesses will not be getting that profit because now loan is costlier, so what their profit margin will go down. Profit margin will go down. And ultimately what will happen? Stock price will go down. So this, you see, this is Monetary Policy MPC Committee. That's why you are very much interested when this MPC committee is going to happen. And these people create havoc in the market. Your portfolio, 5 crore portfolio will become 2 crore portfolio. If you have not followed properly these people. How it happens, I just tell you that, because it's not that interest rate. You have to follow each and every action of monetary policy committee meeting, whether it is going to infuse liquidity in the market or it is going to decrease liquidity in the market. If monetary policy committee decisions are increasing the liquidity in the market, means market will expand and stock market will go up. Prices will, so if you buy the stock and you can sell, so whatever the price may be, if you're buying at a high price, you can sell at higher price, okay? So buying at 200, obviously it may be very high PE, but you have opportunity to sell it at 210 rupees. So 10 rupees you are going to gain just because of the liquidity problem is coming in the picture. Now again, if the monetary policy is tightening the liquidity, so means sucking the liquidity from the market. And in that case, stock price will go down. And stock price will go down means one, your incur losses, your portfolio value will go. So how this monetary policy does, so understand this, each and every decision is related to the risk of your portfolio. So how this monetary policy does, so what is that? There is the RBI. In India, then obviously we are not looking at only the RBI for the purpose in the stock market. We are looking at all developed countries. Like we very much affected by the US market. We are very much affected by the European market. Okay, we are very much affected by the what is happening in China, Asian market. So all these things, cumulative effect comes in your market. Okay. So RBI what does? RBI controls what is the under the RBI? Your monetary policy, MPC, monetary policy. So monetary policy is responsible for increasing the liquidity or decreasing the liquidity. Clear? So this RBI controls the monetary policy. Then RBI in this monetary policy, there are such things. So RBI all of a sudden started selling in the month of September. All of a sudden, all central banks started selling dollar and buying gold because they knew that Trump has come in the power and the Trump has going to take certain nasty decisions. And before that, in the month of so US and European countries, they freeze the $400 billion of Russia because of the Ukraine war. And they said that no, we are not going to give this money to you because you will use this in war. And if war escalates, so there will be a world war, fear of world war. So they freeze it. And this incident brought fear among all countries, central banks, all countries' central bank. They thought that if they are having currency in dollar, or if they are having the US securities, US bond, if I have enough currency as a central bank, I am purchasing US bond, US security, because the safest bond, US treasury bonds are the safest bond. So I will get some interest. But now every central bank thinks, okay, if I'm buying US treasury bonds and US says, no, I will not give you back your money. So all of a sudden, every country central bank, they decided to sell dollar and buy gold. And that's why your this gold price has gone more than 1 lakh 10 grams. Okay, that was the reason, because people are not buying gold. Central banks are buying gold. And most of the countries were putting their this gold, like India was putting its gold in the UK wallet. And they thought they saw that the European action. Tomorrow I need money, and now UK says no, I cannot give you your gold back. So India took all gold back from UK. They said no, we will now manage our gold. We will create our wallet. We don't need your wallet facility. Earlier, people were all central banks were keeping their gold, their things in these wallets, because these wallets were well managed, and they thought that we are not so secured. Our army is not so secured. If all of a sudden there is an attack, so all gold will be taken by the enemy and all those things. And again, gold is taken as a collateral to get the loan also. So now this whole policy of the central bank has, because the US has lost trust in the process. Europe has lost trust. After Brexit, UK has lost trust because they are looking at their policy. They are not looking at the world policy. And when the US and UK together freezed $400 billion of, then the China has also started selling US securities in the market. And China's investment was there in US securities was 1,400 billion, and they have brought down to 700 million. Now, how much you can just see that the response why the whole world is now because of the whole crisis. That's why this is the problem of the portfolio managers. So, how much China is selling US securities, US government securities. Like you have enough cash, what you do? You go for the bank for the secured investment. You go to a bank and you take the FD. That's why the central bank, what they have, when they have the enough cash, they buy the secured government treasury bonds. So now you just see how much China is now. Just see. Japan is the biggest holder, shed some 25.6 billion of US treasury during December. Are you getting this thing? Hefty 44.1 billion. Can you see my this screen? 44 billion were sold by China and the UK. And what will happen? If you start selling treasuries, so what will UK will what will happen?
Dollar
What is
value
Dollar will depreciate.
I'll depreciate or appreciate? Now
depreciate.
US has to pay dollar, na? They will start buying dollar to pay you. So dollar will appreciate. Dollar will appreciate and rupee will go down. That's why Sitaraman says that no, dollar is appreciating. Why a dollar is appreciating? US is buying dollar to return dollar to Japan and China. Suppose I have given you money and you have issued me a piece of paper that I owe 1 crore. And when you will produce this thing, or you can sell this 1 crore in the market, you will get 1 crore. So now I'm going to you and say, you take this, your piece of paper, and now give me the dollar. So from what you will do? You will purchase dollar from the market. And once you purchase dollar from the market, what will happen? Demand for dollar will go up. So these investments were there in the US Treasury bond, and they were liquidating the Treasury bonds. And what they were getting in their Treasury? They were getting the dollars. And what they were doing with the dollar? They were buying dollars, using dollars to buy gold. This was the twin process. It is going like that. And that's why you see, this is the news of the 23rd April 25. So China and UK respectively leave their holdings to now. China was having more than $1,400 billion in US treasuries.
Sir, a question, sir, on the depreciation appreciation. Actually, DXY, if you've seen, has fallen from about 110 to about 97, which is the dollar index.
Dollar index is the weighted in terms of the 6 currencies. There
Correct.
are 6 currencies. It's not only US. Dollar index is not only dollar.
Sir, but it has the largest weightage of the dollar index is dollar.
Just a sec. Just give me the idea.
Sure.
The dollar index is going more than 100. Suppose dollar index is 109. What does it mean? It means that dollar has appreciated 9% vis-a-vis of these 6 currencies, basket of this currency, okay? If the dollar index goes to 89 or 90, it means the dollar has depreciated 10% vis-a-vis of the index of, or the basket of these currencies. Now, what is the dollar index? Dollar index will go down.
So that is exactly the question. So earlier you were explaining that
dollar index will go down. There are 2 questions you are asking different.
Sir, you were suggesting earlier that the dollar.
I will both the things. I'm index and other things are two different things. Dollar index right now, what is happening today?
Today it is about 98, less than 98.
It means the US dollar has depreciated 2% vis-a-vis of these currencies.
Correct, sir.
Okay.
Yeah.
Now, if this is the one thing, whether how there is a basket of currency, it's a portfolio. Against this portfolio, what is the increase in dollar and what is the decrease in dollar. Now come to that. If the supply of dollar becomes more in the market, if the supply of dollar becomes more in the market, what will happen?
Prices
And
will go down.
why supply of more in the market? Because all
Because there are
central
more people who are
banks,
selling it.
all central banks are selling
Selling
dollar
dollars.
buy gold.
Correct. Exactly. So that was the point when I suggested that the dollar will depreciate as a result of it.
हाँ, so जब supply बढ़ेगी तब करेगा. But initially, dollar was what was happening. When
What has
US,
been happening is that all these central banks have, as a result of what you've explained, has been selling dollars.
yeah,
Now,
yes,
when
yes,
they
yes,
sell
yes, yes.
dollars,
When
when they sell dollars, dollar will depreciate.
Okay, you just see. It's a whole process started from September. Okay,
Right.
dollar crossed 111. When they start selling it, they're selling the US treasuries, dollar was appreciating. Dollar graph you just see. And once they sold dollar, means the US was taking dollar to taking their they were trading and they were selling their this thing and converting into the dollar. At that time, dollar index crossed 109, 1010. And then when these banks started buying gold, means what? They started spending in the dollar and buying gold. So gold price went up and dollar price went down. And that's why it is 97 right now. Are you understanding these two actions?
So I am saying the same thing, but in a different context, that they started selling dollars, and there was, instead of what you were suggesting is buying dollars, I'm suggesting this all the currencies across all the RBIs, central banks across the world started selling dollars.
Yes.
As a result, you've seen that the
So
dollar has
the
started
dollar index
depreciating.
will go down. Will go down.
And that is evident from, yes, that's exactly it. So when dollar index goes down, you call it depreciation.
So it has not happened all of a sudden, no? Initially, dollar has gone up because US treasuries were converted into dollar. So dollar was appreciating.
So that is a confluence of several factors. Trump being in position was earlier anticipated as something which will happen better for the US economy. And as a result, therefore, people were suggesting that hence, because US economy may come back from its doldrums of an extremely high deficit economy, and hence people started having some faith in dollar in the period from about September to January. But since Trump has come, the trade tariffs and even other results have not shown that there has been any improvement in US economy. The countries started selling dollar even more, which is the confluence of the gold, their intention of buying more gold. And as a result, you've seen that dollar has fallen against the basket of currency.
Dollar had depreciated. Yes, dollar has fallen. Yes.
Fair enough, sir.
So just tell me, you have to just understand the graph, monthly graph of dollar index. Are you getting this? My point here. It's not correct. if you open, once you are converting US securities, it went up and then it started going down. This is the not, it's not coming monthly, 6 months. March, April. Just see, it is, I'm unable to get it. You can get the full chart.
Sir, should I share?
No, I can get it.
You'll have it over here. Correct.
Now just see.
So do it for 1 year, you will get a picture. पीछे में.
So it is. I'm not interested more than, but it started the dollar, US dollar index. It is started September. You just see. Okay. Now people where the dollar index was increasing like anything. Are you getting my point? This is increasing. Why
Wait,
dollar
sir,
index increasing?
this is the point where the
Yeah, the
politics
US,
of the
they were
government was
converting,
changing.
the central banks were converting these US treasuries into dollar. So in the demand, the dollar was at that time, I will just show you where it has gone. Yeah, yeah. Just see, it was more cross 109, my dear. One and 10. It was January, near about January. And then after that, lot of supply of dollar in the market because people are buying gold. And if you plot this, gold, can we plot simultaneously gold on this? No.
So are we going away from our topic?
And do gold, yeah, gold. Gold future as a US ons में डाल दे. No, it's you see, when it is going down, gold prices are going up. Just inverse relationship between gold and the US dollar index.
What it say?
Okay. So what I was telling that once countries were converting their paper into dollars, so there was a lot of demand of dollar in the market. So supply of dollar was less, demand was more. So that's why the US, the dollar index or USD INR, whatever you say, it has gone up. So this was the first phase. The second phase, when the US, the central banks started selling dollar because they were not having, obviously, the Maheshwari talked about that the one factor is that people are having a very fearing from the tariff things and other things, and US economy is not responding, and the Powell and the Trump are not on the same page, and this has been apparent. And the way Trump was behaving, people lost trust in US economy. And once people lost trust in US economy, means they lost trust in dollar. And once they lost trust in dollar, supply of dollar has gone up. And once the supply of dollar has gone up, dollar index has gone down. And you have seen the dollar index is currently, dollar has depreciated 2% around, 2% around, 2% depreciated vis-a-vis the 6 countries of currencies, basket of currencies of six countries. So that was the this you just see 97.87 means dollar index is now this is the 97.87. So this is means that dollar has depreciated now. It means what? There is a lot of supply of dollar and demand of dollar has gone down. This is the this is the way you can, and once the demand of dollar has gone down means what will happen? Indian rupee will appreciate. So if you just see the what is the USD INR rate, it has gone up. Now USD INR rate. So when I'm talking about whichever the country is on the denominator, like you understand, this is also how to read the exchange rate. This is also a technique to read. So what is this USD INR rate? So I just want to, because most of the people don't know that. Maheshwari must be knowing, but most of you may not be knowing. USD INR. So we write numerator and denominator. So we take 1 USD is equal to how many INR? So 1 USD, it will be 1, and then it will be now 85 rupees. So for $1, this is now if I say INR USD. So now for 1 rupee in 1 rupee, how many USD? So you will find that 0.004, something like that. If you divide 1 divided by 85, so this will be that will be the rate. So here 1 is, so that will be the rate. So whenever you are reading any currency, so which currency is there in the numerator, that will be known as 1, and for that 1, how many currencies of the denominator are required. So in this way we read the exchange rate. Okay, so if you take the pound, British pound, USD INR, GBP, so that's why I'm writing first. And the moment for this, if I am using INR USD, what will be the rate? It will be different, because now I am saying INR in the numerator and USD in the denominator. So now this will be 0.12. So for 1 rupee, I will get 0.012 United States dollar. Similarly, if I am putting GBP to INR, so GBP INR, so I am like this. So GBP to INR. So for 1 pound, I have to pay 167 rupees. But if I just reverse it, I'm interested. I'm going for in 1 rupee, how many GBP? So this will be entirely different. You just see 0.006 pound. So whenever reading currency, please understand that numerator will always take value 1, and for that 1 value, whatever the denominator currency is there, how many values of that currency to meet up that value 1 of the numerator. Okay, so that was the different in the context, because that has to be taught to tell that because I have experience, most of these students are unable to understand what's the difference between USD INR and INR USD rates. So that's why I wanted to explain. This is a simple interview question. Most of people, we generally ask simple question. If what is the INR USD rate? So they will be talking about the USD INR. No, I'm asking what is INR USD rate. Okay. So people get confused about that. So you have, that's why I just wanted to, because it's a very subtle interview question to demoralize a candidate. Okay, you don't know how to read the exchange rate. Anyway, so my question was that how to increase liquidity in the market. So monetary policy committee. So what RBI does? What is the job of this thing? So obviously they control the interest rate, they control the money supply by changing interest rate, and they control the exchange rate, and they also they can print note by money supply by printing notes. And so printing notes is the they can do that. And then they are the regulator for banks. Why I am talking about that? Because this is the whole thing, liquidity risk of your portfolio depending upon this policy, and how you are going to measure the liquidity risk of your, or the market risk of your portfolio. So there are public sector banks. There are private sector banks. There are foreign banks. And there are NBFCs, NB, non-banking financial companies, NBFC. These are all are under the governance of the regulatory governance of the RBI.
Sir, may I ask a question?
Yeah. Who is there?
Rishi, Maheshwari sir.
Rishi, tell me, yeah.
Sir, you initially started with 7 questions. Which question are we on? Which part of it are we understanding the risk of the portfolio?
Yeah. Going to, you are coming to the why stock prices respond to IR, increase or decrease.
Okay.
And then I'm coming to do, because I told you that SD is not correct measure. Then how I'm going to see, unless until I know मेरा कितना loss होने वाला, मैं कैसे risk measure करूंगा, कैसे hedge करूं, ठीक है ना? तो अभी मैं आपको बता रहा हूँ कि आपकी पोर्टफोलियो की वैल्यू कम क्यों हो जाती है, अचानक से आपकी पोर्टफोलियो की वैल्यू कम क्यों हो जाती है, बता सकते हैं आप? आपने 5 करोड़ का पोर्टफोलियो बनाया, अचानक से 4 करोड़ 80 लाख का कैसे हो जाता है?
No, sir, understood. One of this reason is that the liquidity gets constrained as a result of it. When liquidity gets sucked, तो आपके पास सबके पास पैसा कम होगा for expansion. Expansion नहीं होगी तो growth नहीं होगा तो stock price में impact होगा.
तो ये कैसे पता करेंगे कि liquidity बढ़ रही है या liquidity, क्योंकि आपको पता करना है ना, आपको कैसे पता लगेगा कल liquidity market में ज्यादा होने वाली है या कम होने वाली है? कैसे पता करेंगे? आपको portfolio manager बताइए आप मेरे को. You just give me the market. You bring this because you are an experienced person. You bring the market experience to us, the whole class. Yeah.
So sure, sir. So the ideal way to figure out is that whether आज के दिन में the one way that you already showcased is that inflation कहाँ पर है. That is the first point where monetary policy committee takes its stance. अगर वो stance ये है कि inflation बहुत high है, so then they need to constrain the liquidity either means of increase in CRR or by means of raising interest rates or buying back some bonds. तो किसी भी तरह से बैंक से पैसे वापस लेना चाहिए so that banks ज़्यादा easily liquid अपनी currency को दूसरों को ना दे, multiplier effect कम हो जाए. Multiplier effect कम होगा तो लोगों के पास पैसे constrained होंगे. So and this is monitored, credit growth is monitored on the RBI side on a monthly basis. हर NBFC banks को अपने data देना होता है on a monthly basis. तो समझ में आ जाता है कि liquidity लोगों के पास कितनी है कितनी नहीं है. I've understood that part, sir. So now you were trying to relate this to the risk of the portfolio. Now I've understood that part also. But the second question is very interesting, sir. If the standard deviation of the return is not correct measure of risk, then what is the correct measure of risk?
The value at risk and the expected shortfall. Why both VAR and expected shortfall can be taken as a risk measure?
हाँ sir. वो मतलब I am not aware of the answer to this. आप जब समझाएंगे तो I'll be able to understand.
पहले तो यही तो बता पाऊं कि आपका मार्केट में प्राइस कैसे ऊपर चलता है और लिक्विडिटी कैसे. आपने CRR एक ही वर्ड यूज किया ना.
मतलब अब तो बहुत तरीके हो गए सर आजकल तो।
हाँ, आप बताइए और मॉनेटरी पॉलिसी और क्या करती
सो
है?
एक तरीका सीआरआर है, दूसरा ओएमओस करना है, तीसरा अब आजकल जो सरकार ने एक नया तरीका भी निकाला है, वैर इज व्हाट दे कॉल इट, आई एम नॉट अवेयर ऑफ एग्जैक्टली कि
वही।
किस तरह से उसको मेजर करते हैं। तो आप वो दैट्स व्हाई आई सेइंग कि जब आप सिखाएंगे तो आई विल बी एबल टू कोरिलेट विद इट।
इसीलिए मैं टाइम लगा रहा हूँ और हो सकता है कि मैं ज्यादा आपका खींचूं भी, ब्रेक ब्रेक नहीं दूं। तो या तो अगर आप सीखना चाहते हैं, नहीं चाहते हैं तो फिर मैं छोड़ भी
नहीं नहीं
दूंगा।
सर, वो कहीं टाइम की वजह से हम बाकी चीज
तो
सीख नहीं
पहले
पाए
पहले
इसलिए।
ये आप तो रियली आप सही कह रहे हैं, पर देर आर मेनी वेज टू, आपको हर चीजें ध्यान से देखनी है। मैं अभी आपको दो चीजें बताने वाला हूँ, ठीक है?
श्योर श्योर सर।
ठीक है, तो आरबीआई जो जो है वो किन बैंकों को, ये पब्लिक सेक्टर बैंक्स को कंट्रोल कर रहा है, प्राइवेट सेक्टर बैंक्स को कंट्रोल कर रहा है, फॉरेन बैंक्स को कंट्रोल कर रहा है, और एनबीएफसी का। और हम ये पर्टिकुलर पार्ट क्यों करना चाहते हैं, क्योंकि अगर आपको ये अंडरस्टैंडिंग है तो आप आज के मॉनेटरी पॉलिसी का डिसीजन इंडिया में और यूएस में कल मार्केट में क्या होने वाला है, ये आपको आज ही पता लग जाएगा, या मीटिंग के तुरंत ही बाद क्या होने वाला है, या आप इस कमेटी की मीटिंग से आपको क्या एक्सपेक्ट कर रहे हैं, वो मार्केट में ऑलरेडी इनकॉर्पोरेट हो जाता है। अगर मेरे को पता है कि इंटरेस्ट रेट इज गोइंग अप, मॉनेटरी पॉलिसी इज गोइंग टू डिसाइड अबाउट, ऑब्वियसली द स्टॉक प्राइस विल गो डाउन, तो आपको दिखाई पड़ेगा कि मार्केट गिर रहा है। अगर मेरे को पल रहा है कि नहीं नहीं नहीं, ये तो इंटरेस्ट रेट डाउन करने वाले हैं, मोदी जी की बात सुन ली है, या ये बढ़ाएंगे नहीं मार्केट में, तो स्टॉक प्राइस गिरता नहीं है, या तो स्टेगनेंट रहेगा या बढ़ेगा। तो ये कैसे होता है? लेकिन सिर्फ इंटरेस्ट रेट से ये नहीं पता लगता है, इसलिए मैं ये क्वेश्चन आपको, लोग इंटरेस्ट रेट करते हैं, इंटरेस्ट रेट से कुछ नहीं होता है, इसमें बहुत सारी चीजें। तो आरबीआई जो है, पहले तो इन लोगों को कहता है कि आप यहाँ पे बिजनेस कर रहे हो तो यू हैव टू डिपॉजिट सिक्योरिटी, सो उसको कहते हैं CRR, कैश रिजर्व रेशियो। CRR इज नोन एज द कैश रिजर्व सेविंग, जो कि ये जो है सारे बैंक्स, whosoever is working in the banking field or the financial companies, they have to have security to be deposited in RBI. And RBI does not give any interest on this money. जैसे आप घर लेने जाते हैं रेंट पे, तो कहता है 6 महीने का रेंट यू हैव टू पुट एज अ सिक्योरिटी. So this CRR is supposed to be cash reserve ratio. And cash reserve ratio is decided not all of a sudden. It is decided your net deposit time liability, some percentage of net deposit time liability, and suppose this is given as now the CRR is equal to 5%. So 5% of NDTL has to be deposited by every bank. So if you have a deposits of 100 crore and of net deposit time liability is 100 crores, so you cannot lend out 100 crores. You will lend only 95 crores, okay, not 100 crores. So 5% will be reserved cash with the RBI. Now RBI इसके अलावा कहता है कि आप, ये तो आया आपका CRR कैश, there is another ratio that is the SLR, statutory liquidity ratio. ये भी है NDTL का certain percentage. Now they have to, this money will not go to the RBI. This money, SLR, will be invested in liquid assets by the banks. So SLR is suppose 80%. ये हर साल चेंज होता रहता है, ये एक फिगर नहीं है, हर महीने में, 6 महीने पे, 3 साल पे, आप डोंट गो बाय, बट अंडरस्टैंड। तो अगर मेरे पास 100 करोड़ रुपए थे, डिपॉजिट्स था मेरे पास, अब मैंने 5% तो रख दिया CRR के पास, RBI के पास, जिसपे मेरे को कोई लोन नहीं मिल रहा, और 18% मेरे को रखना है लिक्विड एसेट्स पे, मींस गवर्नमेंट बॉन्ड्स, जो कि और भी जो भी और लिक्विड सिक्योरिटीज है, कमर्शियल पेपर्स हैं, इसमें मेरे को दिखाना है कि 18%। तो मैं 100 करोड़ मेरे पास डिपॉजिट्स आ रहा है। बैंक का बिजनेस क्या है? यू विल गेट द डिपॉजिट एंड यू गिव द लोन, यू आर गिविंग 9% इंटरेस्ट or 6% interest, 7% interest on various your products on deposits. and then you lend that money in the market and you get 14%, 15%. So difference is known as the net interest income, NII. Net interest income is the bread and butter of the banks. Now net interest income is increasing or decreasing. ये भी एक बहुत बड़ा मार्केट में असर डालता है, क्योंकि यही तो इनकम है बैंक्स की. बैंक की इनकम अगर डाउन हो रही है और एनपीएस, नॉन परफॉर्मिंग एसेट, इज गोइंग अप और इज गोइंग डाउन, ये फिगर्स आपको साफ साफ बताते हैं व्हाट इज गोइंग टू हैपन इन द मार्केट. नाउ telling me the liquidity part. I'm interested in the liquidity part right now. So SLR, if SLR is increased, what will happen? Tell me. Statutory liquidity rate has been increased. So it means money, liquidity will go down. Money has been sucked. If CRR has been increased, what will happen?
Same, sir. Same effect.
Same effect. And if CRR 50 basis, it has gone down, what will happen? More liquidity.
More liquidity.
Banks will have more money to lend. So these are the basic ratios: cash reserve ratio and SLR, through which RBI controls the liquidity. Later on, these banks, what they see, they have the opportunity to give more credit in the market. So what they take loan from the RBI, because I am giving loan at 12% and my cost is 7%. So I'm getting 4% profit. So I will take more loan and give it to the public. So when RBI gives loan to banks, there are 4 rates. One is the repo rate. This repo rate is only for 2 to 14 days, not more than that. Then second is the overnight, 1 day. So that is known as the MSF, marginal standing facility. Marginal standing facility, less than 2 days, less than 2 दिन से ज्यादा, less than 2 days से अगर है तो आप कहां पे जाओगे? मार्जिनल स्टैंडिंग फैसिलिटी. इसका रेट भी रेपो रेट से बहुत ज्यादा होता है, बिकॉज दिस इज द इमरजेंसी. दिस इज नोन एज द इमरजेंसी फंड. If lot many banks are taking MSF, means RBI से ज्यादा MSF उठा रहा है, it means there is a problem, or they want to give, because 1 day की problem हो रही है. So there is a problem of liquidity in the market. Because MSF is going up, means they are discouraging the banks. The third thing is that bank also want to take for the larger periods. So long-term loan from RBI. This is known as the bank rate. So bank rate is also much higher than this thing. And then whatever these people banks, so banks give credit to public. So there are 2 rates. So now banks give credit to public. So there are 2 rates: prime lending rate and there is a base rate. Base rate is given to the Malaya and Adanis. Whatever you get loan, you get the PR, prime lending rate. Okay. Now banks also, when they have enough money, they give back to RBI. So banks give back loan to the RBI. This is known as the reverse repo. Banks giving money to RBI. When RBI gives to bank, this is known as the repo. And when banks gives to the RBI, it becomes the repo. So this is the thing, and you have to understand if PLR is increasing or the base rate is not changed. So Adani's and Ambani's and all companies, they will get at the same rate. Market will not respond. Base rate is the basic, all favorable customers, they get loan at base rate. PLR is changing, but base rate is remain same. It is not going to affect the market, mind it. Because this is a general public rate, and this is the rate which is the businesses are getting. Now, if CRR is decreasing or SLR is decreasing or repo rate is decreasing or bank rate is decreasing or marginal standing facility is decreasing, it means there is more liquidity in the market. Means there is a policy. So market policy. So so if market MPC, the nature is strong or so is inversely proportional to liquidity. So tight policy means what? Tell me. Tight means MPC policy means what?
Less liquidity.
Less liquidity. Yes, very good. Means interest rates are higher. Repo, MSF and बैंक रेट ऑल तीनों पे देखना है आपको और इसमें क्या हो रहा है CRR is going up, SLR is going up. इन सब के अलावा एक और इस सॉफ्ट मॉनेटरी पॉलिसी मींस सॉफ्ट MPC means more liquidity और तो यहाँ पे ये ऊपर जा रहा है, ये ऊपर जा रहा है, ये ऊपर जा रहा है, तो यहाँ पे क्या होगा? स्टॉक मार्केट में क्या होगा? स्टॉक मार्केट will go down. More liquidity means interest rate is going down. All interest rate or CRR is going down or SLR is going down. This means the stock market will go up. इन सब के अलावा एक और रेशियो है जिसको हम कहते हैं कैप्ट ऑल बैंक्स टू कीप. तो ये तो हो गया डिपॉजिट पे, NDTL पे. सो CRR and SLR are decided on the net deposit on the percent or the net deposit time liability. So CRR decided as a percentage. That has gone. Yeah. Cited as a percentage of net deposit time liability. इसको हम कहते हैं NDTL. इसके अलावा एक और रेशियो इनको रखना पड़ता है, कैपिटल adequacy norm for market risk, credit risk, and third is the operational risk. So right now, suppose ये भी हर हमेशा CA capital adequacy norm, capital adequacy. This also around 12%, 12% of equity will be invested in liquid assets. तो बैंक के पास जो कैपिटल है क्या है? बैंक कैपिटल क्या है? क्या किस पे बैंक कैपिटल क्या है? किस पे लोन देती है? डिपॉजिट्स प्लस इक्विटी. और अभी स्टेट बैंक ऑफ इंडिया ने अपनी लिक्विडिटी प्रॉब्लम को सॉल्व करने के लिए 10,000 करोड़ का बॉन्ड के लेके आए. तो ये डेट, ये तीनों ही ये बैंक के कैपिटल को बनाते हैं. डिपॉजिट्स आर, तो इसको कैपिटल में हम नहीं कहें तो ज्यादा अच्छा है. बैंक गिव्स लोन ऑन, बैंक गिव्स लोन, जो लोन दे रहे हैं, सो अमाउंट ऑफ लोन, अमाउंट ऑफ बैंक लोन or liquidity depends on whether the deposits are increasing, equity की पोजीशन क्या है, और बैंक ने जो डेट बॉन्ड इशू किया है, जो बैंक हैज इशूड अ बॉन्ड. अभी सारे बैंक बॉन्ड लेके आ रहे हैं क्योंकि उनकी इक्विटी तो बढ़ नहीं रही है और सबकी क्राइसिस हो रही है लिक्विडिटी की. मेजर इंडियन बैंक्स आर फेसिंग लिक्विडिटी क्राइसिस. अभी आप इसको डाल के देखिए. तो ये आपका जब भी मार्केट गिर रहा था ना, नवंबर से नवंबर ऑनवर्ड, तो सारे लोग बोल रहे ट्रम्प ट्रम्प. ये ट्रम्प नहीं है मैडम दीप्ति, ट्रम्प है लिक्विडिटी प्रॉब्लम ऑफ इंडियन बैंक्स. आपने डिपॉजिट ले लिया, मेरे से डिपॉजिट लिया कि मैं आपसे 5 साल का डिपॉजिट ले रहा हूं, आपको इतना पैसा इंटरेस्ट दूंगा. जब 5 साल मैच्योर हो रहा है तो आपके पास पैसा ही नहीं है मेरे को देने के लिए. सो डिपॉजिट्स आर डिक्रीजिंग. इसको समझ लीजिए बैंक की प्रॉब्लम क्या चल रही है, इंडिया में क्या चल रही है. सो डिपॉजिट्स आर, सो बैंक के जो मैच्योरिटी, तो डिपॉजिट्स आर, तो उन्होंने आपने हमको कहां से पैसा देते? जो आज का डिपॉजिट है तभी तभी तो देते उससे पैसे से. सो डिपॉजिट्स आर डिक्रीजिंग, but the credits are increasing and there is a mismatch. Great problem it is going to happen. और अभी सारे इंडियन बैंक्स ने मिलकर आपका इलेक्शन फाइनेंस किया. इतना बड़ा इलेक्शन हुआ, अगर एक बूथ पे 1 लाख रुपया भी खर्चा हुआ तो पैसा कहां से आया गवर्नमेंट के पास, बता सकते हैं? पढ़िए. Indian banks are currently facing a liquidity crunch, meaning they have shortage of readily available cash to meet their obligations. This deficit has been by various factors, including increase in credit demand, outflows of the foreign portfolio investor जो यहाँ से पैसा लेके भाग रहा है, and the Reserve Bank of India's intervention in the foreign exchange market to manage the rupee value. Okay, so बैंक लिक्विडिटी की प्रॉब्लम आ रही है और ये पूरा अगर आप इसको चार्ट पे आप देखेंगे, एफपीआई आउटफ्लो इज अ मेजर प्रॉब्लम. वो यहाँ पे क्या कर रहा है, स्टॉक को बेच रहा है, उसको डॉलर में कन्वर्ट कर रहा है, निकल ले रहा है. तो these are the problems जो जिसकी वजह से मार्केट बहुत देर तक आपका उठा नहीं. अभी तो फिर भी ऑपरेटर्स आर देयर, दे आर वर्किंग ऑन इट. सो मेरा कहाँ मैं अपनी तरफ से चला गया। अभी एक और किस्सा आपको दिखा देता हूँ। नाउ अडानी हैज बीन बैंड बाय ऑल इंटरनेशनल फाइनेंशियल एजेंसीज, दे विल नॉट गिव लोन टू अडानी। सो अडानी का तो बहुत सारा इंटरेस्ट गवर्नमेंट में है, बहुत सारे उसके प्रोजेक्ट्स हैं जिसमें कि गवर्नमेंट फंसी हुई है। तो अगर अडानी को नहीं मिलेगा पैसा तो क्या करेगी गवर्नमेंट, बता सकते हैं? सीआरआर कम करना पड़ेगा। तो आप देखिए सेम वाई अडानी आप टाइप करेंगे आपको मिल जाएगा। ये अंडरस्टैंड है, ऐसे ही मार्केट में आप इन न्यूज से आप अंडरस्टैंड कर सकते हो मार्केट कहाँ जाएगा। वाई इंटरनेशनल फाइनेंस कंपनीज decided not to give loan to Adani Enterprises। इसी से आ जाएगा। Are you getting this? इसको जब पढ़ के देखेंगे, international financial institutions have been hesitant to provide loans to Adani Group to a combination of factors, including fraud allegation against the company founder, and the group's very high debt levels. These concerns have led to increased security and reassessment of the lending practices by global bank। अब ये देखिए न्यूज कब की बता सकते हैं ये? ये न्यूज है टाइम्स ऑफ इंडिया की, मैं आपको बता रहा हूँ। ये न्यूज कब आई है? नवंबर 22